Kimberly Clark is an American multinational operating in the paper business, which has a very interesting performance this year. They have lost year-to-date 5% of their share value and roughly 15% from the peak of the year, which was roughly in the first quarter. While most companies in fast-moving consumer goods are focusing in managing their margins and therefore delivering growth, if they deliver growth, through increased pricing, and so to value-driven revenues, losing volumes. And this approach, by the way, is often criticized by investors, analysts, and experts. Kimberly Clark made the decision of investing some of their margins to support volumes, which gave quite good results, both with growth in the American market and in the international market. In the international side, unfortunately for them, volatility in foreign exchange impacted them negatively. So that didn't really bring the expected results. But in the US, they grew, and they grew in volume. Of course, they didn't grow in margin as much as they want. The bottom line is that there is no reward for this strategy, which is why the stock price of Kimberly Clark is below year to date. And this exemplifies the pressure that the boards are putting on the C-suite for delivering results, and the boards, the investors. So both growth in volume and margin protection, which very often means with these shocks and inflationary trends, increasing value as well. It's almost an impossible strategy. So the challenge is persistent and it's difficult, very tough. What are other signals that emerge from the Kimberly Clark story? Well, a barbell portfolio strategy is a necessity. Working on both premium products, but as well as more mass market mainstream offering to cover both volumes and value growth and margin. Of course, the devil is in the details, and the combination of the two will also define how well we protect our margins from shocks. On the other hand, what is very important is that any type of volume requires maximum advertising support. So advertising cannot be cut. It's investing in the right means and the right tools, in brand building and in performance marketing as well. The right equilibrium, the right balance really depends on the category and the region, to be honest with you. Finally, supply chain resilience is critical. There is no way around it. And a lot of people are talking about localization, which is an option, which might drive results. But I think this needs to be looked at what it means in the medium and long term. I am not against or in favor. I'm just saying that localizing to improve stock pricing now, it's not a very good strategy. It needs to make sense in the medium and long term, because otherwise we create competitive gaps in the mid. Let me know if you agree with me. Write a comment, get in touch, and let me know what you think. Look forward to hearing from you.